Warren, we're in a very uncomfortable period. And when we're in the middle of this, it usually looks as if this is the first time it ever happened. The markets will never recover again. But we've been here a number of times in the last 25 years. We had 30, 40, 50% drops a few times. But if we look at our clients and their portfolios, the structure around that, what are we doing and how's the portfolio structured when we enter this turbulent waters?
You're right, Theo. I think uncomfortable is the word. I mean, we're sitting here now within our social distancing space, and you know, if cameras were different, we would be okay. But that's the kinds of things that we have to think about that we would never have really considered before. So when we have those kinds of personal, almost safety kind of human issues, it becomes very hard to be rational about investments. And so one of the things to look at when we talk about portfolios is just how are they constructed, how were they constructed, and are they able to deal with these kinds of situations. And I think the first thing to bear in mind there is we have two views in most of our portfolios. In other words, we've got half of the money typically that's indexed, so it's tracking one or a multiple of different kinds of indices, so usually cash, bonds, property, shares. And then we've got the other half of the portfolio, which is actively managed, where we're paying fund managers to look at the markets, to move the portfolios around, to adapt to the environment. And that's an important consideration. But when we look at the index portfolios, that doesn't mean that we've just created those portfolios and it's fire and forget. What we're doing inside those portfolios is we've created very strict rules long before this issue started on how those portfolios are constructed, firstly, but secondly, how they are managed when things move in big movements like we're seeing now. So for example, when the international markets are dropping 30 or 40%, the rand is moving crazily, the JSE is dropping, those portfolios are not doing nothing. They are actually quite actively managed, even though they're indexed. So the two sets of rules that are built in there is that those portfolios rebalance on a quarterly basis. What does that mean? That means that if the portfolio is supposed to have 67% in shares, and that's starting on the 1st of January, and the stock market drops a lot, at the end of January, that balance will be restructured so that the portfolio has 67% in shares again. So that means that some cash, some bonds, some property might be sold and some shares might be bought to get that balance right. That's an important consideration because we don't know when the markets turn. And you don't want to be in a position where you've bought a portfolio that has 67% in shares and suddenly when the markets turn it only has 10% in shares and you miss out on all the recovery. So there are a lot of shock absorbers that we've built into that portfolio. However, in the quarter, so let's just say 1st of January to the end of March, if there are really big moves and those allocations that we've built in go out by more than 10%, the portfolio managers do rebalance those portfolios as well. So we've got two sets of really good shock absorbers built in there. And it means that when markets are booming, our clients are not overexposed to shares at the wrong time. When markets recover, they're not underexposed to shares at the right time. So on the passive side, lots of rules, lots of safety measures, lots of shock absorbers, lots of brakes, lots of good suspension, all built into that vehicle to get our clients in the direction they need to go. On the active side, we're really careful about who we choose. So we typically pay money to active managers who are kind of negative people. They kind of have a world is ending philosophy a lot of the time when they buy investments. So now this is the time where they tend to flourish because they've been positioned for bad things to happen. They didn't know it was going to be Corona. They didn't know there was going to be an oil crisis, or I should say an oil trade war between the Saudis and the Russians. What they did know was that they felt uncomfortable about the state of the markets and they had positioned their portfolios for bad things to happen. Bad things are now happening, and when you take the active portfolios and you take the passive portfolios, you combine them with the different sets of risk parameters that we've put in there and the risk management that we've put in there, they will deal with these market conditions well. It's very much like a ship in a storm. The ship's going to go up and down depending on how big the waves are. They're going to get moved around by the big tides and the big winds, but the point is the ship won't sink and it'll get you in your direction. And I think that's a critical point here is we've done a lot of work before the time to deal with this. We are very active in this. We're monitoring the situation. We're making sure our clients are okay, but their ship is not going to sink. They will be okay. Markets recover. This time it's different because it's Corona. Last time it was a financial issue. The time before that it was the IT bubble bursting or 9/11. There's so many reasons why markets fall apart. But it's amazing when you look back over time, somehow markets survive, somehow portfolios grow again, somehow the sun rises, and somehow our clients still do okay. And that's going to happen this time again.
Although it looks like nothing is happening from the outside, These rules will build within the building blocks of the passive side of the portfolio and the active portfolio. But I think people should actually focus on other things now. When we come out of this, and it'll happen, it's just a matter of when, we have to make sure that the communities we do business in, the communities we are economically active in, is still maintained. You have to find ways to support the community, and that includes the people that are dependent on you for their income. What we shouldn't do is now walk away from that communities. That's the first aspect. The second aspect is I hate the word social distancing. It should actually be physical distancing. But that doesn't mean that on different kinds of media that you engage with the people around you. You should do that because this is a time when people feel secluded and they outside of their comfort zone. But Warren, from a financial point of view, from a personal finance point of view, what are some of the elements that one can focus on in this environment?
Absolutely, Theo. I think it's a really valid point that people are need to focus on is around their communities. For our clients who are restaurant owners, we should look at maybe what's going on in New York, where they're selling vouchers to meals that you can use later when the whole issue is over. That's a great idea. So I think all of us, we have that responsibility to each other and to our clients to look after ourselves, look after our clients, look after our communities, look after our domestic workers, for example. If you are going to send your domestic worker home, please pay them. If you can at all afford it, please do your social duty here, because it has a huge economic impact on you in the future. It may not be direct, but it is there. And I think it's important not to become overly selfish here. You might be physically isolated, but you can still be part of a community. When we look at the financial planning, I think there are a couple of things that people can do. So if you're earning a salary now and you've got a bit of extra money now because tax breaks are there, fuel prices are down, etc., now is the time to save. Now is the time to try and double up your savings if you possibly can, because it's going to bring your financial freedom date earlier, and possibly you can save yourself years in this instance, because there are some quality investments out there available at really good prices, especially in South Africa, but also overseas. And then I think the second factor is those that are retired, those people who no longer have an incoming but they've got outgoings. For them, there's very little they can do in terms of their monthly expenses. I understand that, and we're not saying to you change your lifestyle now if you are in that position. But what we are saying is, if you've got planned annual expenses or planned every 5-year expenses, for example, it's time to change your car. If you can wait and it's still safe to do that, rather delay that decision until later. Delay it until the end of the year or possibly until next year, when markets and stability is back in the environment, because the likelihood is your portfolios will be up. So where you can control your expenses, do that, but don't collapse your whole cost of living and your whole way of life if you were in a decent financial position before. I think it's a real factor here in that you don't have to change every single thing in your life. I think also just for those of us that are looking at the rand and the dollar, or the rand and the pound, we're getting asked that question quite a bit at the moment. We feel it's time to be very careful about making very big decisions. So if people are sending money out, we think currently the level of the rand to the dollar is about 15 rand to the dollar, and somewhere around 20 rand to the pound. The likelihood is that people are going to be sending out pounds at the moment and not dollars, because the rand is quite a lot better against the pound, although not great anyway. And it's important for our clients to understand this is really about the dollar being incredibly strong. It's strong against the pound, it's strong against the Oz dollar. It's not about the rand being incredibly weak. So we are looking at sending money out, but at those levels. For those that are still wanting to send money out, we would say to you, please do it in phases. Don't send everything out at once and invest everything on the other side. If you've got lump sums that you want to invest in South Africa, or you need to, we think now is a good buying opportunity. That means if you've got 100, spread it out in a third over 3 months. If we're investing money overseas, we're doing the same thing, but over 6 months. We think that there is still a lot of volatility in the international markets. The JSE is much cheaper than the international markets. So we're very careful there not to put all the money in at once. And we're also very careful to suddenly become bottom feeders or stock pickers where suddenly we think we know what Sasol's going to do. At the moment, we're taking diversified views where we're spreading across the index or into a portfolio, but we're not going to just buy individual shares because they've lost a lot of money. There's nothing stopping an individual share from losing even more if it's actually not a viable business anymore. We don't know the answers to those, so we're spreading our risks as much as possible. What we would say to all of our clients in this environment is keep your head. hold course. We're here, we're watching, we're maintaining the investment views that we need to, we're adapting where we need to, but we're not taking radical action now because we've built, a lot of our planning has been built around bad times. We didn't know what the bad time would be, but we knew they would be here. We've made that promise to our clients over and over again. We promised to lose the money in bad times. It's now. This is the bad time, and this is what your portfolios are built for. They will recover. But you have to stay the course. You can't go into cash now and expect them to be able to get back in again when things are better. By the time things are better, your portfolios are up, and investors will have made a lot of money by doing nothing. So it's an important message here is that we're saying to people, we're not putting our heads in the sand, we're ignoring what's going on. What we're saying is, you're paying us to worry, you're paying us to maintain a brief over what's going on. That is what we're doing, and trust us to do that. You are well positioned as long as you stay the course in your plan. And best of luck to us all. Let's stay safe and be healthy.